Okay. Thank you very much. The joys of technology. I can't wait to see everyone in person when we have like our workshops or things together live. That will be so much fun. All right. Thank you so much, everyone. Thank you for being with us for another class on Wednesday. Today, I thought I'd like to go back to something more traditional and talk about the technical analysis, and which it could be helpful in multiple markets. So I thought let's work on that, and decided to focus on a couple of my favorite technical indicators. As you know when we talk about technical analysis, what comes to our minds is the charting, and usually the charting is more of a classical technical analysis that it looks at charts and basically it those price and the charts that we're looking at is the psychology of its players. So for instance, in the classical technical analysis, we look at head and shoulders, we look at the triangles, the wedges, double bottom, and double top, the triple top. So basically that's a visual thing that basically it's based on the chart and the price. We could also mix volume with it, but its classical one is basically on looking at the charts. Then we have the modern, and we have the technical indicators, which is the drives from either volume or the price, and they could be oscillators and things that again the drive from that, and they give us most of the time the trend of the market, the momentum of the market, or they give us the confirmations. There's also the modern technical analysis, some of the things that we use Bollinger Bands, Ichimoku, we look at the mark moving averages. So these are more of a newer things. But for today, I thought I like to emphasize more on the two of my favorite technical indicators, which are there are many more, but today we're going to talk about the MACDs and stochastics. And as you've seen, I use them. Although if you go on Thinkorswim or TradeStation or any other platform, you'll see that probably at least 300 different indicators. And my whole philosophy is we really don't want to overwhelm yourself by using too many indicators. If you can pick and choose a few strategies, few indicators, and find the confirmations, then I think that would be enough. For me, as you know, we talked about the squeeze, we talked about Bollinger Bands, we look at linear regression channels. I do look at the Ichimokus. And as far as the technical indicators, I mostly use stochastics and MACD, and also have the RSI and the momentum and money flow. And other than that, again, everything else is kind of, it could be redundant, but also it depends on your trading strategy or investing strategy. Like for instance, you can use Aruns. Now the Aruns, for instance, they are more of a change of the direction. So if you're a counter trend, they become very attractive. But generally, they don't work on all the markets. But I believe that MACD and stochastics, it should be in everybody's part of everybody's technical indicators. So that's what we're going to work on. It is the subject itself. We could talk for hours and hours just on MACD. So I had to squeeze everything in. So I hope again it's going to be enough information that gets you going. But again, we can spend hours on this. So let's start with MACD. And what MACD stands for is the moving average convergence divergence. And as its name says, by the way, it was created by Gerald Appel in the late 70s. And it is, as I mentioned, the acronym for moving average convergence divergence. And basically, as the name indicates, it's depending on the moving average of the prices. So what it does, basically, it allows us to find its strength and the direction and the momentum. So more of a trend setter as far as understanding the trends of the market. And then secondary will be momentum. And basically, it also gives us the duration because it can go on and on. And it is, again, multi-time frames. When Gerald Appel came up with this indicator, he was mainly focusing on a daily, but it is very much applicable in day trading. And so you can use it in multiple time frames. Now, MACD is unbounded. And when I say that is it can continue when we talk about oscillators, and if you use the oscillators, such as we will talk about stochastics, the oscillators are go from 0 to 100. And usually when they're at 0 to 100, they are, the purpose is most of the time to give us the overbought, oversold indications. MACD doesn't do that, and it can go on and it can continue. And it has no time frame in that sense, and it also doesn't have, again, a limit. So that's why I put down unbounded. So it doesn't have that 0 to 100. And because of that, again, it doesn't tell us, at least from the visual point of view, when you look at it and you think it is so high, it could also go higher. Again, the numbers can continue. Now, one of the things you have to understand as far as the difference between the MACD and stochastic we're going to talk about, MACD is a lagging indicator. It is, what I use it for is for my risk management, knowing where my exits should happen. So it's a more of knowing your, as far as the timing of your exits, more than giving you the directions to get in and get out as far as the head of the game. So it kind of confirms. So, and we will talk more deeply on that. So it is very much, again, it's a lagging, and it is not an indicator that can predict the markets. So also because we're talking about moving averages, basically it is not very good in not trending. So if you have markets are not moving much, I would not use MACD. You will see the moving averages are flat. That's not the time to use MACD. So stay away from them. Whether you're using a 5-minute or you're using weekly or using daily, just be aware of that this is not good for non-trending markets. It's a more of a, again, momentum in the trending markets. So how do we drive at MACD? What is, this moving averages, conversion, divergence? So the way it was created, that's why we calculate the moving averages, and they are exponential moving averages. There's a 26 and in this case 12. Now, before I go any further, these numbers, a lot of people can use different set of numbers. I personally have found out, Appel's original numbers of 26 and 12, they work very well. So I do not change it. But if you like to, if you can shorten it, you could, but it just makes it a lot more, again, volatile, or you can make it longer. So you can try your own numbers. But I believe the 26 and 12 period moving average are the best. And what it is, so what he has done, the first line that he uses, we call it signal line, is looks at they look at the difference between the 9-day or a 26-day moving average and then the 12-day moving average. And it looks at the difference of these two exponential moving averages. So that's the first line. The second line looks at the 9-period moving average of these differences, and that's, we call it the MACD line. So basically that's why you have two lines with when you're doing your MACD as far as indicator. You could also just look at the signal line and you don't need to use the average, but that's what I would prefer. So the majority of your standard platforms, they use this, but again, you can change it. So basically that's plotted, and we use that for our guidance as far as momentum change or the trend change. So one thing MACD has that stochastics don't, and that's the histogram. So we can use the histogram, and what it does, it looks at the difference between the signal line and the MACD line. So this MACD line, we look at if it whether the pace of the line is above the moving averages, the MACD line itself. The signal is moving faster. That means there's momentum. So the more the difference between these two, that's where you get your histogram. And you shall see how, when I look at the charts, hopefully that will all come together. So how do we use these MACD? The MACD, we can use it, the crossovers, which is the lines that we just spoke about, the signal and the MACD. We can use the histogram, which it allows us to know whether the trend is positive, bullish, or negative. And then we, like a lot of other indicators, we use divergence. So for instance, when we talk about divergence, the price, the chart could be going one way, and your technical indicator, in this case MACD, could go the other way. So that's why we look at the divergences. So those are the three main ways we can use it. Now, once we're using a histogram, the height of the histogram, the higher it goes. And you've seen it, for instance, when we did the squeeze with the momentum bars. The higher it is, that shows that the magnitude or the difference between the MACD line and the signal line. So the more it is, the stronger that momentum is, and the higher that it's going, that means the strength is there. It will continue till it changes. So that's what the histogram is important. The other thing is that you will see that some platforms have a change of colors of the histogram. Originally, what it was in some platforms is basically red, which is basically the negative or selling pressure, and green is more of again, the buying pressure. But like Thinkorswim has the same as Squeeze, the momentum bars. It has the darker green. As let's say, when you look at the red, it gets darker red. So it gives us the heads up. So some of them platforms do that, and with changing the color, it tells us the momentum is changing. So we look at the histogram and we look at these color changes again. With I will share the chart with you so you can see that. One of the negative things about MACD is it will give you some false signals, and that's what I always, I need the confirmation. So sometimes that one bar, it goes to negative and then it comes back and goes to positive. So you have to be, again, wary of that. Otherwise, it is an excellent technical indicators, especially again managing your holdings, your trades, and we'll go over how we can do that. So this is a chart from Thinkorswim. So basically, this is the SPY as of today's closing. So what I've done, I've kind of combined everything and that you have access to with your Thinkorswim platform. So what you can see here, you can see our MACD signal and MACD line. So what we talked about, the crossovers, we have the histograms. Histograms are telling us, again, if you're going to be above, if the momentum is changing to positive, that's a buying signal. And what we've done, again, this program was written just for Thinkorswim. What Thinkorswim, what you could have access to, you can also have, we call them crossover buy signals. So for instance, you see these pointers, see there's a sell, and then we have a buy in red. So when the histogram changes to color, and basically when the signals goes over the MACD line, basically that means we are in a momentum, is in a positive momentum. So again, this comes with your Thinkorswim. TradeStation has a different way. They don't have, for instance, you see the colors. what happens is when the color of green changes to darker green, that means the momentum has slowed down. That doesn't mean you short the market. That doesn't mean you have to, you can look at it, maybe lighten up some of your holdings, but still it's not a complete sell signal. Sell signal will be when we actually cross and go to red. Sometimes, like again, with the squeeze play that we've done with the momentum bars, you can play heads up. For instance, you can see that basically our histogram went from the regular red to darker red. That was heads up that the momentum has really slowed down. That means the seller are out of power, they're losing their basically their momentum, and maybe you should look at getting into this position. Now, what happens basically, that still doesn't tell us there's a confirmation. The confirmation will come, and we call them crossovers, in two ways. Number one, these histograms are built on basically what we have, the signal line crosses that MACD line, which is, this is a faster, and this is slower. So that's number one, and that's why you see the color changes. And basically, as I mentioned, these bars are the difference between these two. So the bigger the gap, the larger the bars. And as they get closer, the momentum is changing. And that's what you can see. The momentum of the selling has changed. So for instance, here you see the difference is pretty big. And that's where you have a big histogram bar. As you can see, again, the numbers can go up. They can continue for, this is on a daily basis. So basically on a daily basis, it can continue for many, many days. So there is no really a limit. So you can continue. Now, the most traditional way, or you want to have the complete confirmation, would be the best way to get in to have a more assurance is when your histogram has changed color and it's gone from red to green, but also your signal line is one of them. They've gone above zero. So when it's down here, that means the trend still on the negative. So still there's a bearish trend. When we get above the zero line, that means the bullish trend has started. So now to have, again, complete confirmation for you would be, you want to be above the zero with your two lines, the signal lines. And also you want to have it, for instance, this is on the buying position, you want to have a green histogram. As I mentioned, you could be ahead of the game and start dabbling maybe here. And what has happened today, for instance, this is on the SPY, you can see what is happening. We are above the zero on SPY. That means that basically in this situation, the trend's up, and we are getting very close to cross and perhaps get to the green. So I will watch SPY very carefully, just based on the from the MACD point of view. So you might get a, again, histogram cross and change of color here. So now you might ask, okay, this is great, but how do I, where do I get these pointers as far as my selling indicators right on the chart? So what I like to show you, so what you could do when you are, adding the indicator to your, to your charts, just go to the style and then just type in MACD. This is on Thinkorswim. I'm assuming most of you do have the toss. And then just by doing the MACD, all you have to do is you can add the MACD histogram. You will have the MACD histogram crossover, and that's the one that you click it. When you click it once, it will show you MACD histogram crossover, positive to negative. Now, if you want to have the sell signals, then you again click the second time and just change. When you go here to edit, just change from positive to negative to negative to positive. So this way, it will give you the sell signal and also the buy signal. So by having that, and then you have the histogram, and then you have the MACD two lines, which is again, that's the one 12, 26, and 9. So this is how you can build your, again, your chart and the indicators. So with that in mind, let's say what you wanted to do. Also, you said, well, I really like that and I like to see that flash. How can I scan for this MACD? Again, this is on Thinkorswim. Anytime you do the scanning, make sure you clear your field. I put it on reset, and your reset will clear whatever you had from the past, and unless you had saved it, just go to the study. And number one, get rid of, they usually have the 3 different on the stocks that you can add. I just delete those. You will start very fresh with blank and the scanning tool. Just go to the study, and once you press the study, you shall see there's ADX is quite few the crossovers here, like you can see. Just, I mean, different indicators. Just go to the crossover, and from crossover, you can choose, in this situation, is going to be your MACD histogram. So by doing that, you click on that. Now you have, you can choose whether you're bullish, you want to be negative, you want to be positive. So let's say you want to looking for a new purchases. You think the markets could go up in next few weeks or so, or you're looking at the longer term. You're looking, again, this is on a daily basis. Did we have any fresh, buy? So we go negative to positive. Now you can change this to positive to negative. Look for sell signals. So that's your scanning. As soon as when you do this, you press scan and it comes up with your candidate. So I just did this today, and basically these are the list of, we got quite few. By the way, one of the things I always encourage, if you're going to do the options play on these stocks, basically make sure they're liquid stocks. So you can use any type of a index, any type of company. You can go to NASDAQ, NYSE, you can do sectors. I just chose S&P 500 as my main filtering. So basically I'm doing S&P 500. I have all these candidates, so that tells me there's a lot of volume involved. Now, I also have, we have looked at the volume from the most liquid as far as the volume numbers go. So you can see, we have like GE as the highest volume. So what I did, I said, well, let's look at GE, for instance. So it just came today, by the way. So this is the chart of GE. And what you could see, again, here, you see the color changed, basically went from red to green. Why? Because there was a crossover. So the crossover gives us a buy signal. And because the histogram has changed, there's a crossover, you see this flash right here. This is just from today. So we got a buy signal on GE based on MACD, for instance. Now you could see there was a sell signal not long ago. Now you can, as I mentioned, you can do this on a 60 minutes, you can do it on a weekly. Now, one thing we don't have is yet, we are not above zero. So the trend is not completely clear. So we'd like to have more confirmation. We'd like to be somewhere right around here. We had this crossover. That was a good buy signal. And guess what happened? And that continued. I also added a regular squeeze just in case you're interested. You can see we've been squeezed for a long time. The momentum bars have been changing, but again, you can be ahead of time combining with other indicators if you like. But this is how you can use MACD for your, again, as far as scanning and finding new companies if you like to do some option strategies, whether bullish or bearish. Okay, I hope that was informative. Basically, when we talk about any type of oscillators or the technical indicators, we talk about the divergence. And basically, what we're talking about, for instance, we look at if the price is going up, and I use the histogram, but you can also use the lines. If the price is going up, but indicators are going down, or if the price is higher high, but indicator is lower high, So you see this is going lower while this is going higher. So right off bat, right there, and you can see also in the histogram almost same. You can pick and choose which one you want to use. You can, again, it's a trial and error. I used to use histogram, but you can use, again, the lines. You see clearly there is a divergence, and this would have given you a heads up right around here that maybe we are out of steam. At least if you don't want to short it, maybe you should lighten up in some of your positions. So that's called divergence. And you, again, you can apply it RSI or any other indicators. I like to do it with MACD is one of the better ones. RSI is a good one. So
it's very nice. Yeah. Yeah. So what's going on?
Mute.
No, they want another one of these.
Yeah?
Let's see how.
What about the ABBA?
Please unmute yourself over.
They haven't quite uploaded it yet. They want to change everything. I think even the existing machines, they would all make them redesign the whole thing. So that's gonna be like $50,000 redesign.
Sorry about that. Let me, I'm trying to mute. Please, can you mute yourself? Sorry about that. So basically what I like to do is, this is a divergence here that it actually just gives you a little cheat sheet that, for instance, in the regular, when the price is like, let's say the price is going lower low, but we have the indicators going higher, that tells you there's a divergence and the price will actually, this will be a good buy-in time because of the trending. On the other hand, if the price is like we just saw, higher high, and the indicator is going lower, that tells you that basically this is a sell signal because basically this is not confirming what the indicator, which is in this situation, is leading us. Now, you can also have something called hidden. Now, you could have the indicator is making lower low, but the price is making higher high. Then this also tells us that the indicator is, especially in this situation, it's a lagging indicator. So you can go and go with the price. The same thing on the, if it's a lower price, but the indicator is going higher, the price leads this, the lagging indicator, and that's a sell signal. Okay. All right, so that was MACD. As I mentioned, the biggest things about MACD is it's a very good for trend, giving us trend, the momentum. It tells us the strength. It tells us the as far as the time. You can use those multiple time frames, and but it is, as I mentioned, it tells us when to get out, but it doesn't tell us as far as the leading indicator, in a sense that tells us, well, just be ready to get in. For that, we have stochastic oscillator. And when we use oscillator, basically oscillator means when there's a 0 to 100, and that's the bounded one. So stochastic oscillator, unlike MACD, it's actually a momentum indicator in the sense that it's a leading indicator. So it can gives you the heads up. And if you've noticed in our Saturday classes, I work a lot with the stochastics to gives us the heads up, whether we want to stay in the positions or we want to lighten up. So this one, it goes way back to 1950s, and it was developed by George Lane. And again, it's a more of a momentum leading predictive indicator. So it gives you the heads up. So what happens, momentum comes before the price. So when you have, again, something like stochastics, you could have you can have the heads up, and it will help you to get in or get out from your positions faster. Now, as I mentioned, with the same with MACD, it will work with all kinds of investments. You want to do ETFs, you want to do futures, you want to do Forex, you want to do as far as any type of stocks, and it works very well in different time frames. So how do we use that? Number one, because it's an oscillator, we can find out that with the overbought, oversold. if the, I call the rubber band, if it got really gone stretched, it's a good time maybe lighten up in our positions. The crossovers, similar to MACD, we do have the crossover. There's something called embedded, which I use that a lot. And basically, it's a non-traditional way of using stochastics. And as I mentioned, stochastics are the leading indicator for your position. So before even I go further, let's find out what is actually the formula for stochastics. And there's two different kinds. There's a slow stochastics and there's a fast stochastics. And which one should we use and which one works the best in different environments? So the formula for stochastics is different than we saw with the MACD. With MACD, we were looking at the exponential moving averages, and we look at the 9, 12, and 26, and the average of 9, the difference between those. Stochastics basically uses, again, the time period. Majority, again, the original, when George Lane started, used the 14 bar. You notice that we use that like at ATR, which is average true range, we use 14 days. So basically, all it is something called percentage K. We look at what is the closing price of today and minus the low of the past 14 days. So we look at the past 14, what was the lowest price? And then we look at what was the highest price in past 14 days minus the lowest. So we look at the difference between those two. So if the closing price is closer to being the high of the last 14 days, so obviously the percentage will be higher. So that means if you're in 90% or if you're in 75%, that means we have a nice momentum going. That means in past 14 days, this is positive. So as you can see, this C stands for most recent closing price. L stands the low of the 14 previous trading sessions. Again, it could be days, it could be minutes, it could be 60 minutes. It all depends on the bar that you choose. It could be weekly. Now the high 14 is the highest price it traded. So that's how it becomes a momentum indicator. So it shows us there's more power. The closing prices are going to the direction that is closer to the high of the last 14 days. So now, what is the difference between the fast and slow? Basically, what this K percentage is indication of the fast. That's the number that we use. So for the fast formula, there's something called K, and then we have a percentage D, which is the moving average of the 3 past Ks. So we look at the past 3 days, we look at what was it, and that's it averages out the past 3 prices for the K percentage. Now, the difference between that and the slow, instead of looking at this, it basically looks at this D and looks at the 3-day moving average, so it smooths it. And then for its own D, uses another 3-day moving average, which is almost like a derivative of the 3D moving averages. So if you ask me what is the difference between the fast and the slow, is more of the volatility, because fast is, it will take a lot of actions immediately, so you could have a little more noise than just the with the slow one. I personally use the slow stochastics. I just like it a little smoother. Sometimes it might be a little lagging compared to the fast. It all depends what kind of a market you're using. You want to be in and out quickly, then you would use fast. But generally, especially if you're using daily, I prefer slow, and majority of time I use my slow stochastics. So the classic stochastics, when George Lane came with it, he looked at it, okay, and this is oscillated, it goes from 0 to 100. If it's over 80, we are overbought. And when we are overbought, again, not necessarily you have to short the market, that means get out of your positions. If you go under 20, if you're shorting the market, get out of your shorting the markets. Now, if you've noticed my Saturday's presentations, I use the 70 rather than 80 as overbought and 30 as oversold. And why is that? Because I use something called embedded. And what I want to see is if the stock goes to, the price goes to over 80 and stays there for 3 bars, that means there's a lot of momentum and strength. So that means that's not the time to get out of your position. So, but also another thing is I use the 70. That tells me that if you were planning of getting into that position, if it's 70 and more, you better think again. You're overbought, so there's a good chance you could be a reversion to the mean, and that's why it's not a wise move to get in when the stochastics at 70. So basically, this embeddedness gives us the idea that whether you want to stay in your position or whether you know it is not a good time to short the market, and maybe as long as the embedded stays at over 80 and all the way, it could go to 100, basically you should stay with your position. The opposite is correct. If you're bearish and you were shorting the market, once we get to 20 and we stay below 20 for 3 days and more, or 3 bars and more, depending on what time frame you're using, then that's embedded or locked in, and that's why you want to stay in your position as long as it takes. So one of the things that you want to also take into consideration, we are in an embedded position. Once it turns, let's say it's been at 80 and now 80 goes down to 78, 77, 75. Remember, we have 2 lines, so all you need is like one of the lines. It crosses the K, which is usually the fastest one. If that moves, usually when we get out of embedded, we go to that 18 bar moving average, again, depending on the timing. So that's a heads up, knowing that, okay, that momentum has changed, and usually the markets like to go to that 18 bar. Now, what I will suggest, sometimes when you are embedded, sometimes the markets get to go below that 80, they go to 79 and 78, and then they turn back. So basically that was a kind of a false move. That means that, once it gets to 78, that doesn't mean that you're overbought and just have to get out. Give it a 1 bar, you can, to see if it's, it will come back to that embedded. So that will be a continuation of your hold. If it's more than 2 points, let's say there's a 2 percentages, let's say it goes from 82, it goes all the way to 75. Now, 95 to 98% of the time, that's the heads up that the move has stopped, that it's a good time that maybe either get out or, lighten up part of your position, because there's a good chance it's going to go to the 18 bar moving average. The same thing when it's like under 20. Now, if it's 20, it goes to 21, there's a good chance it might come back and continue with embeddedness. But if it goes from 20 to 25, that means that you're oversold and get out of your shorts. And if you want to start buying, maybe that's what with combining with other indicators, that might be a good time. So what I have here is basically it's a chart for the SPY. Again, today, this is from the trade station, so you can see the difference. This MACD, this is the way the trade station does, so the bars and then the lines, you can see it's the same thing. We are crossing, the histogram is just about to move, and the lines on the MACD, they're above the 0 line, so that's positive. That means the trend is positive. Now, as far as the stochastics, you can see we were, at this point, this was called embedded. So we were here. That meant that, you know what, just stay with your positions, continue. And once we got under, and in this situation, the blue is our fast one, and then red is the average. So this is a K, red is D. The K went under, we came back up. So it told us that this was false move, so stay with it. But this time when we went down and we continued, then that gave us a sell signal. and we did go back to the 18-day moving average. So far, what we have done, we haven't been able to embed. So that's, we still overbought. Now, in this situation, we were overbought. We crossed, and that was a sell signal right there. And we went all the way to, in this situation, to 20, and then we were in oversold. So once we got here, it was giving us the heads up that maybe, you know, the trend is changing. You know, the momentum is actually, I mean, the momentum is changing, and this could be a heads up. And as you can see right now on the stochastics, we are in overbought. So the question is, when we are in overbought, this is, again, we are at 76 or 78. This is might not be the best time to get in, although the MACD is trying to give us a signal. So this is just be aware. We are looking at this, but we are not, we still overbought. So this would have been a good place, maybe getting, or this would be a good place from neutral. So usually what happens is when we are in overbought, we usually go to the midline, a neutral zone, which is about 45, 50, 55. That's when you sit down and evaluate your positions and say, listen, is this a good time? Now, we went past the 50 and then we went all the way down to 20. Then you would, you know, reevaluate and say, well, do I want to get back to the position, or you want to just wait? So in this situation, we are in overbought, so we have to look at other indicators. Maybe you want to look at the 60 minutes, look at the squeeze, and, you know, other indicators. But right now, we are actually overbought. So basically, what you want to do, the embeddedness happens when both lines are above 80. So not just one line, both of them have to be above 80. So with that in mind, I wanted to just wanted to again share something that I've used, and I use that a lot, and basically it just gives me more confidence in my positions. Besides, again, that helps me with the charts. So you can also, again, on Thinkorswim, you can use the stochastics, but also you can screen for stochastics crossover, for instance, if you like, and or if there's an oversold and it's crossing, let's say 20 or 30, you can also do that. So with that in mind, I'm gonna go ahead and let's start recording.